So what we've seen over the past year or so is a large divergence between resources and industrials. Now that's amongst small cap stocks. Basically, if you've been in anything to do with industrials, you've been okay, and if you've been in resources, you've lost money because they've gone backwards. So it's a lot of stock selection and sector selection that's going on there. There are three stocks that have done quite well, and there I'm talking REA, which owns realestate.com.au. Now that's up about 150% over the past year. Also Super Retail Group, which owns Supercheap Auto and Rebel Sport. That stock's up about 40%. And then you've got Breville, which makes the coffee makers, and they've got a lot of international exposure. They've also done about 40%. So managing to pick those stocks that have gone up has put your portfolio in good stead, and avoiding the stocks that have gone down. So basically that's anything exposed to mining, mining services, and engineers as well. So we've also seen this really big divergence between small cap stocks and large cap stocks. Now small cap stocks have performed okay, they're up about 4% over the past year. But then you look at large cap stocks, which are up 24%. So there's massive divergence between the two categories of stocks, if you will. And there's a few things that are driving that. Firstly, large cap stocks have the big four banks and Telstra, which we're calling yield stocks at the moment because they pay this really high dividend yield. And that's really popular, so a lot of people are investing in them, which is driving their prices up. Those sorts of stocks don't really feature in the small cap index, the small ordinaries. You just can't get them. So the ability to go towards that is less in small caps, and that's why we're seeing some of the divergence. Another factor that's featuring is that in large cap stocks, you actually get a lot of global exposure. So you can see companies from the US and indeed global miners that are out there. So one of the other factors is that amongst large cap stocks, you can get a lot of exposure to the global economy. That's less available in the small cap space, where it's a lot more domestically focused. That's the source of their earnings, and that's another reason why we've seen this divergence. Well, all the small cap managers in our portfolio outperform the index, and that's really pleasing and a great result for the portfolio. And there's been a few things that have driven that. It's about buying those shares and sectors that have outperformed, and just as importantly, about not buying the companies that go down in value. Now, over the past couple of months, so let's say since June, what we've seen is resources starting to pick up. This isn't across the sector, this is just in a handful of real quality stocks. So it's been important to know which stocks to buy and which stocks not to buy, but we have seen some of our managers start to add some resource names just in the past couple of months. While everyone's talking about tapering at the moment, which is what's going on in the US with their monetary policy, what's really interesting is that in Australia, we've got record low interest rates. And if anything, there's an easing bias, which means money might get even cheaper. That's a really good thing for retail stocks. Consumer confidence driven by low interest rates might actually see profits for retailers start to improve. The other thing that's been going on is there's been real caution amongst companies about their guidance for the coming 6 months, 12 months. Companies have been wanting to cut costs and not really invest in their business. We're hoping to see some of that start to turn around. The other thing that's interesting, a little bit of strength just in pockets amongst building stocks. Have a look at that in light of what's going on in the broader economy. That might be something to watch over the coming year.